Good morning. So in today's lesson, we will be having financial institutions and market. Now, in the previous lesson, we learned that the primary goal of a management is to maximize the shareholders' wealth in the long run, and that the value of shareholder is determined in the financial market. Okay, so therefore, in this chapter, we describe the markets where capital is raised, securities are traded, and stock prices are established. Now, as well as the institutions that operates the financial market or these markets. Now, first question. To start with, why do business raise funds? First, we have expansion. Second, it could be a purchase of equipment, or it could be a startup capital, or debt payment, or through payment of expenses. Now, these are some of the reasons why business needs to raise money or fund, primarily because the business is not liquid enough to fund its project or plans. How do business raise the capital or fund? Financial management, there is what we call the capital formation process. Now, in this diagram, you can see three different ways to transfer financial capital in the economy. So here it is. Okay. First, we have here the direct transfer of funds. Now, this is the easiest way to transfer capital or fund from both the borrower, the business, and the saver. Okay, the borrower does not need to go through the investment bankers or any financial intermediaries. Now, the scenario here is that there is a direct transfer of money and securities, and it will occur when the business sell the shares, okay, or the firm security through stocks and bonds directly in the financial market without going through any financial institution. Now, for example, a person needs capital to start his own business, but that person lacks of capital. So his friend lends him money to raise fund in order to start up his business. Now, so his friend directly transfers the money to that person. Okay. Now let's go to the second way. We have here the indirect transfer using investment banker. Okay. Now in this way, when the company needs to raise money or to raise up the capital faster, so the company will prefer to go through an investment banker. So this is the investment banker, okay, or the investment banking house to establish new investment securities in order to help the company to obtain financing. Now, for example, XYZ company is temporarily lacking in capital. So XYZ company needs to sell the shares or bonds to the investment banking house in order to raise fund quickly. Now, when the firms sell their securities to the investment banking house, the investment banking house will now resell, okay? Resell the securities to the savers. So the investment banking house is the middleman. Okay, so this is, as you can see, it acts as the middleman between the business and the savers. Okay, now let's go to the third way to transfer financial capital in the economy. We have here the indirect transfer using financial intermediary. Now, in this way, financial intermediaries is also acts as the middleman between the saver and the business. Okay, it acts as a middleman between between the business and the saver. Now, some types of intermediaries includes banks, credit unions, pension funds, and etc. Now, in this transfer, the financial intermediaries will collect the money from the savers that wish to invest, or the savers purchase the intermediary's security. Now, after that, the financial intermediary will use this amount of money to provide financial service, such as provide loans to the borrowers to start up the business. Okay? Now, question, what is the difference between the two? Okay, what is the difference between the two? Now, the difference between the investment banker and financial intermediary is that the investment banker will just resell, okay, if you can see here, whatever the business sells, the investment bankers sells it to the savers, okay, will resell the securities bought from the business or firm, while in the financial intermediaries, whatever the business sells to the financial intermediaries, the financial intermediary will only collect those securities, and then the financial intermediary will issue its own securities to the savers. Okay? It will issue its own securities to the savers to collect money from the savers. Okay. Go to the financial market. Now, financial market, it is basically the mechanism through which deficit units meets its surplus units. Okay. Now, it is the mechanics through which buyers and sellers are brought together to facilitate the exchange of financial assets, which are often known as the securities or financial investment. Thus, financial market exists in order to bring together buyers and sellers of securities. Let's go through the types of financial market. Now, before that, we first differentiate physical asset from the physical asset. Those are the assets that are tangible or real assets with physical existence. Now, for financial asset, it is, or those are intangible financial instruments with contractual provision. Now, here is an example of a physical asset. So if you can see here, you can see gold, grains, corn, vegetables, equipment, anything that you can see, anything that you can hold, anything that is tangible or real asset. Now here, for the financial asset, it is purely paper. Paper with provisions, paper with contractual provisions that represents as a security in exchange with the money that the business needs. Is here the capital versus the money market. So what is a capital market? Capital market, those are instruments with longer maturity. Now, it involves financial assets that have a lifespan of more than 1 year. So most of the time, capital market has this lifespan of 3 to 5 years or 3 years and above. Now, it is a market from which long-term capital is being raised for the setting up and sustained growth of business organization. For the money market, uh, these are the instruments, or it has the instruments with short-term maturity. Now, short-term maturity, it involves financial asset that has a lifespan of less than a year. So in this market of short-term borrowing, uh, it is the market of short-term borrowing instruments. Okay, now the money market and the capital market. Now, if you can see here the money market, we have here treasury bills, commercial papers, and consumer credit loans. Now, these are considered short-term financial assets, considering that the maturity of this are only 90 days or about less than a year. Now, for the capital market, we have here common stock, preferred stock, bonds, leases, and mortgages. Why? Because these financial assets are considered long-term because, for example, in the bonds, it has a maturity of, let's say, 5 years. 5 years. Okay. We have here the primary market. So these are the market where new issues are sold by corporations to acquire new capital via the sale of common stock, preferred stock, or bonds. Now, The sale takes place through an investment banker. Okay, investment banker. Then, in which the corporation raises new capital through, first is the IPO, or the initial public offering. It is also known as the unseasoned new issue, and then the seasoned new issue. These are, or it refers to the offering of an additional amount of an already existing security. Okay, and then the shares involve the initial offering for a security to the public. So unlike IPO, these are new shares being issued to the public. Now for the seasoned new issue market, it is only an additional amount for an already existing security. Okay. Secondary market. Now, for the secondary market, it involves between owners after the issue has been sold to the public by the company, and then the proceeds from the sale of the secondary market do not go to the company, as in the case of IPO. Because if there is an issuance of IPO, when someone or when an investor buys those shares, the money that the investor um, pays will go directly to the business or the firm issuing the IPO. While here in the secondary market, the proceeds of the sales from the secondary market will not go to the company directly. Okay, so in which existing securities are traded among investors. Okay, so example are NYSE, or the New York Stock Exchange here. And here for in the Philippines, we have here the PSE, or the Philippine Stock Exchange. Now, let's have an illustration to simplify the explanation for the difference between the primary market and the secondary market. Okay. Okay, now here. Okay, now in this we have here the primary market and here the secondary market. Now, as you can see, investor A bought the shares from XYZ Incorporation or Incorporated. Now, in this case, the XYZ Incorporated issues shares through an IPO, and then investor A has bought the IPO, and the money has been directly transferred to XYZ company. Okay. Now, in the secondary market, the share that investor A has been holding was bought by investor B. So investor B gives money to investor A, and the shares that was bought by investor A from XYZ was being transferred to investor B. We have here also the over-the-counter market. Now, in the over-the-counter market, market for securities outside the control of the official stock exchange. So, the trading securities are not listed in the physical stock exchange. And then the broker-dealers are linked by a network of telephones and computer terminals through which they deal directly with one another and with the customers. So, this is different from the um, primary market and the secondary market, wherein the stocks or the securities are being listed in the physical stock exchange. Block share trading. Now here in the share trading, traders are institutions. Now essentially a communication network among institutional investors that trade large blocks without the aid of a broker. Let's differentiate equity versus debt market. Now, in an equity market, uh, corporate stocks are being traded. In the debt market, bonds or corporate liabilities are being traded. Okay, so again, when we say stocks, we are referring to the equity. Okay, but when we say bonds, we are referring to the debt market. Okay, here. For the stocks, these are again considered as an equity instrument carrying ownership or interest. Now, there is a dividend payout for this if you have again a preferred stock, so you are being prioritized for the dividend payment. Unlike with the common stockholders, for their returns, there is no guarantee returns because again this is an equity. Okay, so there could be a volatile changes in the stock prices. Now, for the additional benefits, for the stocks, the voting rights will be available if you're a stockholder, considering that you are partly owner of the company. Now, for the bonds, the bond again is part of the debt market, so it is a debt instrument with a promise to pay back the money with interest, and then its return is through interest. Okay, and then there is a guaranteed return. Okay, unlike unlike with the stocks, there is no guarantee return, considering again that the stock price or the value of your stocks could change over the time. While in bonds, the principal amount will be given back to you at the end of the maturity. Now, additional benefits, there is a preferential treatment when bond mature. Okay, so that is the primary difference between the equity or the stocks and bonds. Now, what is a financial institutions? Now, institutions. First off is the bank. We have here commercial banks, which is the middleman between the savers and the borrowers, mostly. Here, investment banks, still a middleman, but it is an organization that helps to sell new investment securities like bonds and stocks. We have here also Financial Service Corporation. It is a firm that offers a wide range of financial services that includes investment banking, commercial banking, brokerage, and insurances. Now, we also have here funds pool money to invest. We have here the mutual fund, pension funds or retirement plans, hedge funds, or exchange traded funds. Now, these are the full of funds, meaning to say, there are different types of securities being invested in one um, in one type of investment. Okay, like for example, in mutual fund, it could be a mixture of a fixed securities, an equity, or a short-term securities. Okay, and then there are other financial institutions like life insurance companies that collects premium and invest. If you have VUL or the variable unit life insurance, it is a mixture between it is a mixture of an insurance and an investment. Part of your premium will go to your investment, and part of your premium will go to your insurance. Okay. Also, it is other financial institution is the private equity, wherein it borrows money to invest or manage the whole company.